When I did my video last month titled Two Growth Stocks to Buy with Massive Upside, I talked about two stocks. The first one was Hims and Hers Health. This stock has been a beast. It's up 54% since I talked about it in this video. I have a much lower cost basis in the $7 range, and it's a long-term investment for me. I'm not selling it anytime soon. But the second stock that I got asked so many questions about, because it has done the opposite of Hims and Hers. And this is Celsius. Celsius is down around 9.5% on the month. It's been an absolute disaster. Year to date, it's down 46% on the year. And this was a very loved company. People used to love it before. But something have happened. The stock starting to go down. It was overpriced. Now it's no longer as overpriced as it was. And now when it went down, people don't want it anymore. And that's getting me very interested. And in this video, I'm going to give you an update on Celsius. I'm going to tell you what I'm doing on Celsius. And I'm going to give you an amazing trade idea for you if you want to enter the stock at a much lower cost basis with a margin of safety. You get paid while you wait. You can take advantage of the volatility within Celsius to get it to your advantage. It's going to be a pretty amazing one. And I really hope you enjoy it. The first thing is, a lot of you are familiar with Celsius. Of course, they market themselves more of a energy drink that's a little bit more healthy with vitamin V, vitamin C, and all that stuff. And some people really like them, some people don't like them. It's a mixed feeling kind of stuff. And they did earn the respect of a lot of investors because this is a highly competitive industry. And not very often you could just start up in energy drinks and then become as successful as Celsius was able to become and take market share from beasts like Monster and Red Bull and other kind of energy drink company. And Celsius went out of nowhere from a 3.6% market share 2 years ago to 11.5% market share, causing a massive, you could say, disruption within the energy drink space. This is highly, highly competitive, and people are loving Celsius. And even Monster and Red Bull, the legacy brands, they've been decreasing in market share, while Celsius has been increasing market share. And this is amazing from the companies. They work with influencers, they work with a lot of partners, a lot of different people, and they do whatever it takes for them to market the product and increase market share. And they were very, very successful for doing that. Now, why the stock has been going down? It's because of PepsiCo. PepsiCo has overstocked the product. This is the whole thing. 2021, 2022, 2023, there was massive demand for Celsius. PepsiCo, not Celsius, PepsiCo overestimated the demand. So they ordered way too many Celsius cans or Celsius products, you could say. They ordered much more than they expected. And now they're sitting on inventory. So that's why Celsius sales are suffering, because PepsiCo, which is a huge partner for them, is not ordering as much as they did. Why? Because they're sitting on too much inventory, because they ordered more than they should have in 2023 and in 2022. This is the whole thing. This is the whole thesis. And if you think about it very well, okay, when the inventory is gone, they're going to order again. This is true. This is all temporary. But the market and a lot of people are acting like this is permanent. And Celsius is just done and it's never going to grow again. And people don't like energy drinks anymore. This is not true, because the company still grew 23% revenues in Q2 of 2024. Earnings per share grew 65%. So people are still buying Celsius, even though PepsiCo isn't ordering as much as they did. But it's mainly, the growth. The growth really killed the stock. They used to grow 140%, then 107%, then 101% for 3 years in a row. This is huge. This year, it's expected to be 6.4%. And I believe this is too bearish. It will end up being a little bit higher. They just grew 23% on the quarter. But for me, what I'm going to show you is the analysts are extremely, extremely bearish on Celsius. There was a massive earnings revision, and you could see it on Seeking Alpha. If you look at the 6 months trend, for 2024, they revised EPS estimate down 26.5%. 2025, they revised it down 32%, and in 2026, almost 34% revision. And this is just gonna kill the stock, and this is what happened. I think it's mainly not just because Celsius isn't growing as fast, but it's because the stock goes down. You might believe that the analysts are a little bit smarter than that. But not all of them. I've seen it with NVIDIA. I've seen it with many stocks. The analysts really, they want to be on the right side of the equations. They want to be right. They don't really want to just give out whatever they believe in. That's just my opinion. I've seen it with NVIDIA. NVIDIA was the same company. When the stock was going down in 2022, they were downgrading the estimates, downgrading the stuff, because they want to be on the right trends. They want to be right. They don't want to be right on numbers. They want to be right in terms of the trend, because this is what everyone's looking at. Prices, no one's looking at the fundamentals of the business. And when Nvidia started going up, they started raising the estimates. And that's what I believe will happen with Celsius. They absolutely killed the estimates, in my opinion, so much that there's very little room for disappointment from here. They already got revised 34% on a temporary problem, which is PepsiCo, that's likely going to improve in the future, and it's going to be a huge blow to the estimates. And as soon as Celsius starts beating estimates and the stock starts going up, then you're going to see the analysts starting to raise estimates, not because anything changed, but because the stock went up. And if you pay attention, you're going to understand what I'm saying. And this is what normally happens. But in my opinion, why I believe they will massively destroy the estimates isn't just because of the PepsiCo situation, but it's mainly because of international expansion or global expansion. If you didn't know, Celsius was able to achieve 100% revenue growth and all of 23% revenue growth and all these things only in the United States. They're not even international yet. They just began in Canada in 2024 January. They just entered the UK in April. They just entered Ireland in April. They barely entered Australia now. They're entering it now in the second half of 2024. They're now entering New Zealand, and they're now entering France. And an international expansion, international growth, which not a lot of people talk about, I think this will be the catalyst that will cause Celsius to beat the estimate, which is going to cause a change in sentiment, which is going to cause the analysts to start upgrading the stocks again and raising them. And I'm very bullish on international expansion. And if you look in the first half, they're only in Canada and I believe in another country, like 2 international countries. They just entered them, and their international is 30% on the quarter and 36% for the first half. And that's 36%. They're not even in Australia, they're not even in New Zealand, they're not even in France, and they just began in the UK and Ireland. So I wouldn't be surprised if international revenue growth is closer to 40-45%. And if you look at it in terms of Celsius, this was a company without much resources, without much experience. Now they have resources, they have experience, they have connections with Pepsi and many different partnerships, many different companies. They have all that stuff. Without them in the beginning, they were able to massively increase market share. They went from 3.6% to 11.5% in the United States. Now, with them having access to all those partners and all those resources, I don't see why they cannot replicate the same thing internationally. And this is what people aren't focused on. Everyone is focused on the United States. But what about international expansion? It could be huge for the company. And with them being such geniuses in terms of marketing, with influencers and many different people all over on everywhere, they're very good at marketing. I just don't see why they cannot replicate the same success. And I think this is where the analysts got it wrong. They're too focused on PepsiCo, they're too focused on the US, but they're not focused enough on international, which is still small. It's still 19 million versus 400 million for 382 for North America, but it's growing rapidly. And I believe it's going to go 45-50% in terms of growth internationally, offsetting the slower growth in the US. 2025, you're going to have an easier year because they're comparing it on 2024 numbers, and you have international starting pulling in as they entered more and more countries in the second half, like Australia, which is huge, France, New Zealand. So I just don't see much room for downside. I see more room for a surprise to the upside than a surprise to the downside with Celsius, especially after the analysts have absolutely killed the estimates. They just absolutely killed them. And this is why Celsius looks much more expensive than it actually is. It's looking at 46 times earnings because the analysts, they revised the guidance way much lower. And before that, when I was talking about it, it was almost the same price. And we were looking at it around 34 times. But it's now showing 46 times because they massively decreased the estimates, which again, in my opinion, this will leave them very little room to disappoint and more room to surprise, which means the earnings per share estimate or the forward PE will likely be much lower than 46 times, maybe 28 to 30 times. But even at 46 times here, Celsius does look expensive. I'm just being honest. If the analysts are right, the stock is expensive, even if they expect 30% EPS growth over the next 2 years. If the analysts are right, Celsius is expensive at 46 times earnings. But my thesis is that the analysts are wrong. And the pain for Celsius, it could be, maybe this could be the worst quarter is going to get better. But I believe the pain or the worst is behind them, or I think it's mainly nearing the end. And as soon as Celsius starts beating on those estimates due to PepsiCo ordering again, due to international expansion in so many countries that they are entering, I think there's a room for them to beat on EPS. When they beat on EPS, they're gonna start revising EPS upward, which is gonna fix the PE ratio much lower. It could be up 28, 30, 32 times earnings, which 30 times earnings is a very fair number for Celsius because they're expected to grow 30, 32%. You're paying one time peg price to earnings growth. And this is an amazing thing for Celsius if you could buy it at one peg. And it's not an easy stock to analyze. It's a little bit confusing, I know. Same thing for solar stocks, because solar estimates are all over the place. No one can predict the demand and fluctuations of solar, and that's why Enphase always looks expensive, then it looks cheap, then it looks expensive, then it looks cheap. Those stocks are very hard to value, and I believe they're more of a speculative investment rather than just an investment that you believe is like you're investing in Pepsi or investing in Coke and you put in 20% of your portfolio. To me, Celsius is a speculative investment, and it should be sized at a small position according to your own portfolio. But this is, in my opinion, the best way to play Celsius or to own Celsius is to sell put options on the stock. And this is the January 2025 $30 put, which means if you sell this put option, if Celsius goes below, let's say if it closes at $29, you're gonna have to buy 100 shares minimum at $30 per share. Now, the best part about it, you collect around $355 while you wait. Now, $355 of $3,000, this is around an 11% return. So you're getting paid 11% for 3 months to get to buy Celsius at $30 per share. And your adjusted cost basis will be much lower. We could do it here. We could put in $3,000, which is the cost to buy 100 shares at $30, but you collected a premium of $355, so we can reduce it by $355, and this would be $26.45, which means you paid a total of $2,645 to buy 100 shares of Celsius at $30, and if you divide it by 100 shares, you get your adjusted cost basis of $26.45. This is a massive margin of safety. You want to own Celsius? You could sell those put options. You collect the premium. If Celsius close above $30 by January 2025, then you keep your $355 and you don't have to buy the stock. But if it goes below $30 by January 2025 and you do get assigned, if you adjusted for the premium as you collected, your cost basis would be $26.45. And in my opinion, this is a massive margin of safety. It's pretty hard to mess it up if your cost basis is $26.45. And in my opinion, if you don't own Celsius, this is the best alternative to own it. That is what I've been doing in my portfolio. I've been selling more and more put options. But if you want to own it, again, it's very speculative. I wouldn't put in more than 1, 2, 3% of my portfolio and dollar cost average down, see what happens. If you don't own it or if you don't want to own it, you could do put options as the premium is huge. And if you want to own it at a lower price, this is a win-win setup if you're selling options. And if you want to learn options, I do them in my group. If you're interested, this is the link. But this is all I had to say for this one. It wasn't financial advice, just my opinion on Celsius. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.